Now that you've had some general overview of the economy and from 2 points of view, what we'd like to do is to progress now to those people who can help us with recommendations and action steps that you can take back to your owners and your bosses as to how to deal with this situation. And to kick us off in that particular area, we'll turn it over to Mike Ellis from Los Angeles. Mike?
Okay, well, after the first two presentations, I do have to admit, I don't know which way the economy is going to go. Is it going to improve? Is it going to stay flat? Is it going to decline over the next 12 months?
Weren't you listening?
But I do have to say that for maybe the first time in a long time, we do have a ray of sunshine, I think, especially with Claire's comments. And I know that my clients are going to greatly appreciate that. We as practicing CPAs, and I work exclusively in the construction industry, West Coast predominantly, Washington, Oregon, California, Arizona, and Albuquerque. And all of my clients are experiencing, as I'm sure most of you are, declining backlog. Upwards to 50%. Many of my clients are saying they expect to do half this year what they've done in the past. I would imagine that that's probably true with many of you here. I would be shocked if the majority of you said you have not seen some decline or another. So all of our clients out here on the West Coast are showing significant increase. In addition, competition is increasing tremendously because as companies have less work, they're going out to find work wherever they can. Work in different geographical areas, work in different areas of their technical abilities. So there are more and more bidders for fewer and fewer jobs. So the competition is huge. We attribute that in large part to a couple of reasons. Credit market, certainly, you heard Morris talk a little bit about that. That's exactly what my clients are experiencing. The lenders to project owners are in a state of paralysis. They're just not willing to lend much, betting on the come, without a lot of equity, without fixed rental streams, and because of that, a lot of projects just are not coming on the books. In addition, and this is where I think we're going to continue over the next 12, 24 months, is those who work in the public sector, states are finding less and less tax revenues. That's going to continue to fall off. That means that there will be less projects coming out in the public sector. So those are things that I'm sure you're all experiencing. My clients are experiencing the same. Now, along with that, it's kind of a double whammy. You got less work, and the work you have has less profit margin on it because of more competition. So the work that is out there to bid on, you're probably finding that it's going for greatly reduced prices. In fact, I would be surprised if any of you didn't look at some of these bid prices and say, how can that company do it for the amount of money that they got it for? So even if you're able to find work, the profit margins is significantly reduced. In fact, the gross profit margin in dollars is falling faster than most companies' overhead costs. So what does that mean? You're going to operate as a deficit potentially for a short period of time. Talking a little bit about the creditor market for the contractors. So banks lending money to contractors. What we're experiencing is that the money is still there in most existing relationships. We're finding banks do not want to pull your loan. They don't want to push companies into bankruptcy. They don't want to own your assets and have to figure out what they're going to do with those. So they are, at the end of the day, giving the money that they had lent previously, but they're tightening on standards. Covenants are being tightened, being put into loan documents, whereas previously they may not have been there before. Interest rates are starting to inch up as the banks start to price the higher risk that they have out there. Maturities are shortening. They want to look at the loan portfolio on a more recurrent basis than they have before, so they're not pushing maturities out very far. And the dollar amounts, they're not giving any excess. Whereas 40 years ago, when they need money, great, how much? The sureties are doing similar things too with their contractors. They're looking very, very closely at financial ratios for the contractors as well. Before you used to be able to just slide through, you were making money, they didn't care about anything else. They're looking much closer at financial ratios to make sure that the contractors that they are rendering insurance to are solid. We're finding that there's not a lot of new and there's not a lot of expanded surety credit out there for contractors that are kind of on the edge. They're also looking at if a contractor's going into an area that they have not previously done, they don't have any experience. Surety credit is extremely tight, maybe non-existent, so they're really looking at the risk there. And they're looking very closely at the character of the owners and the managers of the construction companies. And by character, what I mean by that is, do you do what you say you're going to do? Do you have the expertise in your company to do the things that you're going to do? Are you a stand-up contractor, or do you do things that they found out later? They get real nervous about that. So character is real key for sureties and issuing credit. So the surety credit is there, but you've got to be positioned in a strong place to take advantage of it. All right, now what can you do about it? The first item I have up there is under promise, over deliver. That gets a little bit back to the character aspect that sureties have. You don't want to tell the sureties one thing and deliver something else. You want to build a reputation that you will do what you say you will do so that they know you're very professional